Understanding VIX, the fear index. Calculation and interpretation. The VIX is calculated using a wide range of S&P 500 index options, both puts and calls. It uses the weighted prices of these options to estimate the expected volatility over the next 30 days. A key point to remember is that the VIX measures implied volatility, which is based on traders' expectations for future volatility, as reflected in options prices, rather than past or realized volatility. Why the VIX matters. The VIX is often watched closely by all market participants, from individual investors to large institutional traders, as it provides a quantifiable measure of market risk and investor sentiment. When the VIX is high, it indicates increased uncertainty and fear in the market, which can signal increased volatility ahead. Conversely, a low VIX suggests confidence among investors about the stability of market returns. Put options play a significant role in driving the VIX. As investors buy more put options to hedge against potential downturns, the prices of these options rise due to increased demand, which in turn increases the VIX. The mechanism here is straightforward. The more investors are willing to pay for puts, implying they expect future volatility, the higher the implied volatility and thus the VIX itself. The phenomenon where the VIX consistently overstates realized volatility by about 4% can be attributed to the risk premium investors require to sell insurance against market downturns. Since options can be used to hedge against these downturns, their prices, and therefore the VIX include this premium. This discrepancy suggests that, on average, options are priced higher than the actual volatility would justify, making selling options, especially when the VIX is high, a potentially lucrative strategy. Selling options, particularly in a high VIX environment, can be profitable because sellers can capture the premium from the inflated implied volatility. The key here is the mean reverting nature of volatility. After spikes, it tends to decrease over time, often making the options expire worthless or be bought back at lower prices. There are volatility indices for other market segments and asset classes, including NASDAQ 100 Volatility Index, or VXN, which measures the market's expectation of 30-day volatility of the NASDAQ 100 index. CBOE Russell 2000 Volatility Index, or RVX, which tracks the expected volatility of the Russell 2000 Small Cap Index. CBOE Emerging Markets ETF Volatility Index, or VXEM, reflecting the implied volatility of the EM ETF, which tracks emerging markets. CBOE Gold ETF Volatility Index, or GVZ, measuring the market's expectation of 30-day volatility of the gold ETF. And lastly, CBOE Crude Oil ETF Volatility Index, or OVX, based on the implied volatility of the USO crude oil ETF.